Hello and greetings from Ann Arbor. Welcome to our estate planning workshop. Today's topic is leaving your legacy completely and correctly. I'm Sally Baker, Executive Director of Plan Giving for the University of Michigan. A couple housekeeping items before we begin. Questions can be asked throughout the presentation by using the Q&A feature at the bottom of your screen. They can be typed into the Q&A window at any time during the event. Live captioning is available during today's program. To view captions, please click on Live Transcript on the bottom right of your screen and choose Show Subtitle. I'm pleased to introduce our panelists. Terrence Quinn is an estate planning attorney in Ann Arbor, Michigan, and the founder and president of the TGQ Law Firm. The firm provides clients with the main focus of legal assistance in estate planning, probate law, and elder law. Terrence graduated from the University of Michigan Law School in 2002 and spent the next 6 years in practicing law in trusts and estates practice in the trusts and estate practice group for a major Michigan law firm. In 2008, he founded his firm, the Law Office of Terrence G. Quinn, PLC, now called the TGQ Law Firm. With his signature diligence and grit, Terrence assists Michigan clients with the legal assistance to help them find comfort in what lies ahead. Matthew Wallace is the founder of the Wallace Law Firm, PC, in Port Huron, Michigan. He's an attorney and a certified public accountant. Matthew limits his law practice to estate planning and elder law, business planning, and real estate. He concentrates on estate planning, including charitable planning, elder law, Medicaid planning, and business succession planning. He graduated from the University of Michigan's Ross School of Business with a Bachelor of Business Administration with distinction in 1980. Matthew received his law degree from the Wayne State University Law School. Matthew is an active member of and a regular presenter to many local, state, and national professional organizations. He's a frequent speaker on estate planning, elder law, business planning, and real estate with community and civic organizations and employers. He's published over 500 articles on estate planning, elder law, and related matters in various publications. Donna Snyder joined the University of Michigan's Office of the Vice President and General Counsel in 1997 and is Associate General Counsel. Her practice focuses on charitable giving to the university. She assists professionals, fundraising professionals, and others at the university with the legal, tax, policy, and due diligence issues of charitable giving to the university, and drafts agreements for major gifts, both current and planned. Donna received her law degree from the Marshall Wythe School of Law, College of William and Mary in Williamsburg, Virginia. And now I'm pleased to give you our panelists.
Thank you, Sally. Participants, we were so gratified that you sent in all kinds of questions. We actually will try to cover as many as we can during the workshop, and the Plan Giving team will be reaching out to those of you who have specific questions about giving to the University of Michigan. So let's kick this off with a nice general question, and I'm going to ask Matt, would you give us an overview of how property passes at death?
Generally, in most cases, in fact, most of the death administrations that come into our office from outside of our office, we see them passing 4 different ways. One way is with beneficiary designation. So in Michigan, most accounts can have a beneficiary designation from brokerage accounts, bank accounts, life insurance policies, annuities, and the like. So that's one way that it goes. Another way is joint ownership. Many times that is what banks will advise people to do in the event of a disability or a death. So joint ownership will pass to the surviving joint owners at death. Then any assets, if the deceased has a trust and the assets are titled in the name of the trust, they will pass in accordance with the terms and conditions of the trust. And then lastly, if it is in the deceased's sole name, without any beneficiary designation, it will then have to go through the probate process that will go in accordance with the deceased will, if they have one, And if they don't, it will go in accordance with the will that the legislature has drafted under the rules of intestate succession. And what a lot of people don't realize, if you have a will or a trust, any assets that have a beneficiary designation or a joint ownership other than the will or the trust, it will bypass the instructions in the trust. So joint ownership and beneficiary designation will bypass your instructions in your will or in the trust.
Are there any immediate tax benefits to using any of these particular methods of passing? You know, like tax benefits when they actually set up the will or the trust, beneficiary designation, et cetera?
Yes, there are certain things, and we're going to be covering some of these a little later with regard to specifically with retirement plans, is you can avoid some taxation by having, for example, charitable beneficiaries being the direct beneficiaries of taxable retirement benefits. So you can avoid taxation that way. You can generally, if you have proper beneficiaries of retirement plans, you can, for spouses, you can roll them over into a spousal retirement IRAs, or for non-spouses, you can stretch them out up to 10 years.
Okay, thanks. But I think the person wanted to know is, if you set up, for example, if you set up a trust now, a revocable living trust right now, what kind of tax benefits are there? Not at death, but while they're still alive.
Revocable living trust is, for tax purposes, treated as the alter ego of the trust maker.
Mm-hmm.
So therefore, there's really, it's basically, the trust is actually ignored for tax purposes if it is the typical revocable living trust, which is considered for tax purposes a grantor type trust.
Yeah, that's right. So basically, there's no immediate tax.
Correct.
Benefits. So thank you, Matt. Terrence, how would you look at each of these when you're recommending? And especially, how is property passing by will affected by property passing by trust or beneficiary designation, vice versa, that sort of thing?
Yeah, that's a great question. And first, let me apologize. I'm in Traverse City at the Probate and Estate Planning Institute, about to learn a lot more. And the groundskeeper outside my hotel decided to do the grass as soon as it was my turn to talk. So if you hear that background noise, I'm sorry about that. But to answer the question, it really depends on the circumstances, the current circumstances of the person. In my opinion, the safest route for most people is to use the trust option across the board. That's always my initial go-to. I always start my meetings from the perspective of looking to see if it makes sense to do a trust for this client. But depending on those circumstances, it just depends. So joint ownership is probably my least favorite because there are a lot of risks inherent in the joint ownership arrangement, with the exception of a husband and wife, married couple rather, in most cases, but not all. That's probably not the best route. So I tend to recommend against that in nearly every case. But when we talk about the other three options that Matthew talked about, but again, the trust is probably the best in my opinion, because it's providing, in most cases, it's providing for a probate avoidance opportunity, which mostly everyone wants to avoid probate court. But then in addition to that, it's allowing you to spell out how you want those assets to be distributed over time. So in situations where I'm dealing with a family with a minor child or a beneficiary, a child that may have a special need, those kinds of scenarios, a trust is very beneficial in its many forms. The beneficiary designation option is also probably the best if all of the stars align, the best of all, because it's going to distribute those assets probate free. They're going to go directly to the person who is the beneficiary, and it trumps everything else. It trumps all other options. However, the type of asset and the circumstances of the beneficiary may cause me to recommend against the beneficiary designation at that point in time. You don't want a minor child being the beneficiary of a $100,000 life insurance policy. because that's going to be pretty tricky getting it to them. And then when the child turns 18, we probably don't want the child. You know, I was pretty mature at U of M in undergrad, but if I had gotten $100,000 payout when I was 18 on the football team there, I think I would have saved some of it, but I'm sure a lot of it I'd had a lot of fun. So it definitely depends on the circumstances. But if I had to rank them in order of what I tend to lean on, the trust is usually first with a beneficiary component, a beneficiary designation component, and then the probate option is just there in case we didn't plan correctly. And I just don't like the joint ownership arrangement.
So are you saying that you don't even do a will if you do a trust, or how does the will factor in?
All right, great question. So I tend to point towards, with the exception of a long-term care Medicaid married couple component, which is a broader discussion, I really only tend to recommend wills in situations where a person really does not have any assets, nor do they have minor kids that will be the beneficiary of a life insurance policy, which is not a current liquid asset. And the reason is because a will, and I learned this throughout my experience as a practitioner, a will is really only for probate court. And that's pretty surprising to a lot of people when they discover that a will has no value separate from an open active probate case. It's nothing more than a letter to the court saying, here's who is in charge of my case. It used to be called an executor, now it's called personal representative, number one. And then number two, here's who gets everything after the probate court case is over. And once people understand probate court, they tend to want to avoid it. So a will is not the way to do that. The trust is the safest way in most cases to do that.
So when do you recommend that people fund a revocable living trust?
Yeah, immediately. So funding is a broad discussion, and that is the important next question, because the trust only keeps your assets out of probate court if it has control over those assets. And the process of giving the trust control in the legal world is called trust funding. And so what that involves is adjusting beneficiary designations or ownership of the assets such that the trust is either currently the owner or will become the owner immediately upon your passing because it's the beneficiary of the asset. So I advise my clients immediately to fund their trust. Once we have that signing conference, I spend about a third of that conference going over each asset that they have and giving them my recommendations on how to fund it to the trust if I recommend that they fund that asset to the trust. But it's an immediate thing, and clients should know, and I stress it heavily, that you're not done. You should not be satisfied until you're sure that you've properly funded your trust with your assets.
Matt, how about you? Do you recommend immediate funding as well?
Absolutely. What we have found is that funding can be a very, very tedious activity. What we have done in our office is we started I think in 1999, started doing fully funded trust where we make sure that all of the assets are funded. What I found, at least in my practice in St. Clair County, what I found is that when we allowed the clients to try to fund their trust, I did that for the first 13 years of my practice. And in 13 years, not one single one of my clients fully funded their trusts. So we started doing it ourselves. And actually that has held true now for over 35 years. Not one single trust that has come into our office from outside our office has been fully funded. So, and most of them go all four ways at the time of death. So some assets are going joint, some are going, a beneficiary, some are probated, and some are in the trust. So what we try to do is we try to make sure, and oh goodness gracious, my charger is not working. So what we find is that most of the what we want to make sure, though, is all of the assets are funded in the trust, and we will continue to meet with our clients until the assets are fully funded.
So actually, one of the questions that came in was about trust instructions and whether it needed to be instructions be left with the trust documents, or do they need to be in the formal trust? So I think that means, some kind of separate instruction, or should it be like directly in the trust? Matthew, are you still there?
Yes, I am. I'm just connecting my charger to make sure it's charging, because I'm down to low battery mode. Just a second here.
Okay,
And
well, let me flip that question over to Terrence then.
we
Go
are,
ahead.
we are back.
Okay, go ahead, Terrence. Would you mind answering that one?
No, not at all. Yeah. So, so you're asking specifically about when it comes to, can you repeat the question for me?
Yeah, so the question was, can instructions be left with the trust documents, or do they need to be in the formal trust?
Yeah, so they certainly need to be in the formal trust, because the trust is what governs what happens. The trustee is only bound by the terms of the trust itself. So outside instructions really don't matter, really don't count. And the trustee really doesn't have to do that. In many ways, I think it can be risky. Although I'm not opposed to it, I think it can be risky to leave outside instructions, because once a person is gone, let me back up. The whole purpose of a trust or a will or a power of attorney is to give people instructions regarding what you want to have happen with your stuff or you at a point in time where you can no longer tell us. And so most of the disputes that happen in court are around what the person wanted, because they aren't here to tell us. So when we have documents outside of the governing formal document, the trust, the will, the power of attorney, that says something, attorneys make their money in the gray area. And so, we have a problemed beneficiary or omitted heir who wants to create a problem. And if there's any wiggle room to do so in a document that doesn't even count, like written instructions separate from the actual trust, you can have a big case on your hands trying to figure out what the person intended. So I think it's safest not to leave outside instructions, although I have helped clients do that on occasion where the client thought it was important to do so. But the instructions should be in the trust.
Yeah, I'm not sure exactly what they're getting at, but maybe tangible property or something where a list that changes over time might be, and that might be outside of the trust.
Yeah. Now, and with that though, that's a great point. I think with tangible personal property, I know I do provide a separate document that's not stapled into the actual trust document itself, but it's referenced by the trust document. And so it's a part of the trust effectively by reference. But as that question came up, I envisioned a separate note that said, hey, I did a trust and it says give everything 3 ways between these people. And by the way, I want X, Y, and Z. And I think it's a little scary. I get a little nervous as a practitioner, as I think it just adds opportunity for someone to challenge things.
Thank you. So Matt, one of the things you did not mention that is very common though in estate planning is power of attorney. And one of the questions was, when should people set up a power of attorney for financial matters, and when should they activate it?
Well, actually, what I recommend is that if the person is over the age of 18 and not incapacitated, they should at a minimum have a financial power of attorney, healthcare power of attorney, and at least a will. And many times, even 18-year-olds, it makes sense to have a trust. But my son was in my office on his 18th birthday, doing his estate plan. Because I've had quite a few number of our clients who have kids away at college who had accidents or otherwise with no documents, and because of HIPAA, the parents couldn't talk. They were prohibited from finding out what happened to their children. So if you're over the age of 18, not legally incapacitated, will, power of attorney for healthcare, power of attorney for finances, and maybe a trust.
Okay, very good. Terrence, when should folks begin estate planning? And then after that, when should they review it?
Yeah, great question. At age 18, I couldn't agree with Matthew more. Everything he said, I agree 100% with what he just said. So I think if you are 18 years old, you should begin the process of estate planning. And I mean that. Estate planning is the process by which attorneys help you determine your answers to what happens if you're gone, what happens to your stuff and to your children. And number two, if you become incapacitated, who can handle business for you and what would they decide? Now, we never know when either of those situations will become our reality. But once you reach one of them, you can no longer do a plan. And so from the moment that you have authority to handle business like this, which is age 18, you should take care of it. So in other words, if you're above 18 and don't have it in place, you really should consult with a true estate planning attorney immediately to get it in place. And it is that important. Now, as far as reviewing, I was trained earlier in my practice to review plans every 3 to 5 years. Since doing that, I feel that that is bad practice. I don't think that's good in any way. And I meet with my clients on an annual basis. I look at it as like a doctor's checkup. We go when we're interested in our health. We go to the doctor on an annual basis to make sure we're healthy and to make sure we're working towards remaining healthy. Your plan, in my opinion, covers the two questions that I just referenced, which I feel are two of the 4 most important questions everyone will deal with in one way or another in their lifetime. And so since they're so important, I think that you should stay on top of it. I counsel and advise my clients. I let them know I should be involved in your life throughout the year. If really anything goes on, you acquire another property, you're considering long-term care, if you have another child or whatever it is, I should know. And letting me know doesn't mean I'm going to always charge you. But letting me know does mean I can look at what's going on and let you know if it's significant enough to require a change. Now, every year we should get together regardless of any significant occurrences, just to review the plan to make sure it's still healthy. And last thing I'll say about that for now, people often balk at that idea when I mention that to them, because they're like, oh, nothing's going to change. I'm going to want this. And people are amazed how in a year, when we go over that plan to review it, there are things that they do want to change because life happens or law happens. And in either case, we need to adjust it a little bit. So I think every year is the proper way to approach a healthy plan.
Thanks. And Matt, one of our questions was, how specific can the changes be?
As far which changes?
To a person's trust, when a person wants to make changes to their trust, how specific?
Very specific. They are their instructions for their, when they are unable to, act for themselves and after they're gone. So they have to be very specific of basically, providing for them and their loved ones during their mental incapacity. And then when they're gone, give what they have to whom they want, when they want, the way they want. So all those changes, sometimes they're very, very minor. Like I did one this past week where we changed a couple of charitable beneficiaries in a trust. But then we had another one last week where we literally restated the entire trust because there were so many changes to family and other issues that we restated the whole trust. So it varies. I agree with Terrence. I meet with my clients on an annual basis. And just like with Terrence, our clients are amazed, when they go through, because when you review their plan on an annual basis, these are complicated documents. And every time you review it, they pick up on a little bit more and they understand it a little bit more. So at that point, they really understand what's happening, what's going to go on during their mental disability, what's going to go on after they're gone. So I, highly recommend, updating and reviewing on an annual basis also.
So speaking of that, while you're talking, Matt, what do you think about, a question just came in about the best approach for picking the person or whatever to manage your healthcare financial issues when incapacitated?
Well, I recommend using people who have the skill set that is necessary for that job. For example, mean, you don't want to have a highly emotional child who can't make a decision to be making a decision regarding whether to remove life support.
Right.
You know, so, so you pick someone who is, you don't pick someone who is a spender and can't handle money to handle the finances. So you choose either family members or professionals who have that skill set to handle that particular job. And the financial agent is not necessarily the same as the healthcare agent.
Okay,
That's right.
Terrence, I see you nodding. Do you want to add anything?
Yeah, I agree with that. And I think you also want to consider for all of these roles, the person who will understand the family dynamics, understand what you wanted, all of that. Because sometimes from a medical perspective, with the medical healthcare power of attorney, maybe the family is such that that John would need to keep Sarah and Tamika involved and engaged in this, or maybe not. Maybe if you bring Sarah into it, there'll be a problem. And so you don't want that to happen. So you have to have someone who also can understand those dynamics if those are present, so they can navigate that appropriately. Because there are a couple of things going on with that. Number one, we want to make sure you're cared for on your terms at a time period where you can't tell us what those terms are. So we're relying on the document and the discretion of the person. But you're also, in my opinion, I'm helping clients create a situation that will limit as much as possible conflict later. So it's not only making decisions to care for you, but also navigating things in a way that can limit conflict as best as possible. Because I don't want my clients going into probate court to have things settled if I can help them avoid it. And I know they want me to help. I make more money if we go to probate court. However, that's not why they hired me. So I'm trying to help them put that together in a way to avoid it.
Yeah, I've always said you pay the attorney to do the estate work now, or you pay the attorneys 10 times more after your estate does after you die in order to
That's right.
fix it. And 10 may be a small number. I don't know. All right, let's switch gears and talk a little bit about charitable gift planning. Terrence, you work a lot with churches and the charitable bequests that people make to them. Would you give us the church's point of view about charitable bequests, particularly when donors put restrictions on those bequests?
Yeah, the first viewpoint is please give from the church. Please do it. We're happy that you do. But yeah, so a lot of times, I'll give an example. I'll tell a story. I worked with a church recently up north that had a mechanism that people could give towards. And that mechanism, it was an endowment. It had the donor had certain specific restrictions that had bound the church for years. And so the gift was set up where it could only go towards someone who was a member of the church, who was graduating and going to college and planned to major in social work. And for the last 15 years, they haven't had anyone that fit that description. Meanwhile, the church had other things that could have helped the church function better. I think they mentioned to me they had to put a new furnace in the church, and it would have been great to be able to lean on some of that for that purpose, but they couldn't because it didn't fit the description of or the restrictions of the gift. So what I do now, and I'm working with another church as we speak to set up an arrangement like this, and I push the churches very much to arrange the structure in a way where they can get a donor letter from the donor that will provide the restrictions, and then the church negotiate with the donor around those restrictions. So in many ways, the broader the gift, the better positioned the church will be to use the gift for the church's benefit. That doesn't mean that donors should not say specifically, I want this to go for to a student going to a certain school, but just understand that from the church's perspective, that ties their hands in ways that could become very inconvenient and inefficient at some point in time.
So when clients ask you about assets to give to the church or charity, what do you usually recommend?
Yeah, so it depends on the value, how much they want to give. If they're giving something very nominal, then it almost doesn't matter how they give it. But as they're starting to get into broader, larger numbers, larger figures, we're looking at the types of assets they have. So if they have significant life insurance and significant cash that isn't in some form of a qualified tax deferred account, then but they also have another asset that is in some form of a qualified tax deferred account, and they're trying to decide how they do that. Probably I'm going to end up recommending some arrangement where the tax deferred asset goes to the church so that their children don't end up taking the hit for the tax at the time of payout. Because remember, those qualified accounts and tax deferred accounts, the asset is going to be taxed when the recipient receives it. The asset is going to be taxed at that recipient's tax level in many cases. And so if the recipient doesn't pay taxes, hence a charity, a church, then the family will not be impacted by that tax. If they're receiving the life insurance through the trust, for example, plus the brokerage account through the trust, for example, it will not hammer them in the same way as if they were listed as the beneficiary on that 401k. So a lot of times that's a way to get those assets out, get as much of the asset out to the family as you want to, while also benefiting the charity or the church.
So on that sort of same thought, Matt, we got a question about, so if the owner of a deferred investment, like, some kind of retirement investment, designates his or her estate as the beneficiary, and then the will directs the executor or personal representative to fund the charitable bequests out of these accounts to avoid income in respect of a decedent, will this work to avoid income taxation? And the questioner says, I understand, of course, it'd be best to just designate the charity as the direct beneficiary, but if you don't know what account you want to designate, then will it work to direct the executor or personal representative to figure out which asset would be the best?
Well, it's going to be the famous attorney answer, depends.
It depends. That's what I was going to say.
Because what happens is if it's a specific dollar amount of bequest, then that's a principal distribution, not considered the distribution of income. It goes to the estate first, then the estate pays the income tax at its rate. And so when they make the charitable bequest of a specific dollar amount, that is considered a principal distribution. So you don't avoid the tax at the estate rate. However, if the charity is a what we call a remainder beneficiary or percentage beneficiary, and they get a distribution in the same year that the IRA or qualified money is distributed, then it will pass through to the charity on a K-1, and there would be no income taxation at the estate level. But if it's distributed the following year, all bets are off, then you pay it at the estate on that year. So it's what we generally do is we name the estate or the trust as the primary beneficiary, the charities as the contingent beneficiary, and then we do a wait and see. And then after death, we see what's going to be best. And then if it makes a sense, then we do a disclaimer from the estate or trust to go directly to the charity to avoid. And let's say for an asset that is not going to go 100% to the charity, you do a partial disclaimer. And so you do a partial disclaimer, and that will go to the charity, and then the rest will go into the estate. So doing it that way, you have the best way, what I call post-death tax planning.
That sounds like that works well. So Terrence, another question came up. Instead of waiting until a person dies, are there tax deductions available by annually giving a series of charitable gifts, while living, that would add up to the lump sum that the person might have included in their will, and then maybe decrease their taxable estate? I guess there's like 3 questions in there, but basically, can you give annual gifts and end up decreasing your tax?
Yeah, you can. That's a great question. And sometimes it gets fun trying to figure this out on the spot. So gifting up to 15 or somewhere around $15,000 annually to any one person can occur annually without any tax that needs to be paid or accounted for at that time. If you go above that amount, you still don't necessarily, to any individual person, you still don't necessarily have to pay taxes on the amount above that 15,000, but you do need to notify the IRS annually that you did give a gift beyond that that exemption amount in any given year. And you can give those 15,000 plus or minus dollar gifts to really as many people as you want to in an annual year. And so that's a way that you can start to reduce your estate, so that at the point that you pass, you've lowered that number and hopefully brought it down under whatever the estate tax credit amount is at that point in time. So that's what some will do. And then of course, a husband and wife or a married couple can in some ways combine those gifts and give up to roughly $30,000 on an annual basis to any one person or multiple people. And so a lot of times that is a strategy that people would use to lower the value of the estate, so that the children, for example, would be benefiting from those assets now and can use those funds to grow it on their own behalf, and then hopefully avoid an estate tax after their parents are gone.
Very good, very good. So Matt, charitable remainder trusts. At what level, someone's asking, at what level assets does this make sense? So the person said, many articles says one needs substantial assets, but what is the minimum substantial? And I can just tell you right here, if I can throw this in, a little U of M advertisement, if you will. So for the University of Michigan to be trustee of a charitable remainder trust, we require $100,000 for to fund the trust. All right, Matt, what do you think?
Well, the thing is that if you're going to be benefiting, a charity, and you want to be able to receive some funds during your lifetime, that is one way to do it. So you would have to look at what the cost of setting it up is versus the benefit. Now the other thing is that there are calculations under the Internal Revenue Code to see whether you have a current, the amount of the current charitable deduction is. And then your total of all of your itemized deductions have to be in excess of the the standard deduction. So you have to really look at all of that to really make sense. So there is no cut and dried. You just have to see if it makes sense to you to do it.
Another, it depends.
I'm curious, do lawyers ever give cut and dry answers?
It depends.
Not so often. Yeah, it depends. Yeah.
So a question came in. This is going back to serving as executor or personal representative, and either of you can take this. Should the attorney who writes up the trust document be able to be the executor or personal representative for that trust, or, well, trust document? So they mean the trustee, I think. Or is that a conflict of interest?
Yeah, I'll start and then I'll throw it to Matthew. I don't like it. Like I almost always refuse to be a trustee or a agent under a power of attorney of anybody's plan other than my parents. I think they might have named me, though they might have changed that recently. Anyway.
That's another issue.
Yeah, that's another issue, right? I think it creates a conflict. There's no, it's not one of these situations where it cannot be done, but it certainly creates a conflict. And there's an even greater, I think it creates somewhat of a conflict, but there's a greater conflict, of course, if the attorney is a beneficiary as well. There's a lot of case law on that deals with it being a troublesome situation potentially. So I think what's better is to appoint someone that is not your attorney, and then in some ways encourage the trustee or agent under power of attorney to work with your attorney, because your attorney should be extremely familiar with your life and your situation. The estate planning attorney's job, I feel, is to help you build, maintain, protect, and properly leave everything that's a part of your estate, which includes you. And so they should know. I tell my clients all the time, they really, I'm like the one person in all of my clients' lives who really has to know everything about them. And so having me work alongside the trustee, I think is a better, safer situation than having me act as the trustee. Though I know some attorneys do it. Matthew?
I would agree with Terrence. I myself rarely ever act as the personal representative or trustee of my clients' estates or trusts. For two reasons. Number one, I agree with Terrence that it is a conflict. I have seen too many cases where attorneys have convinced clients to be the trustee and the personal representative. And then I've seen them charge a personal representative fee. And then they hire their own firm to be attorney for the estate. So they get an attorney fee for the estate. Then they get a trustee fee for being a trustee. And then the trustee hires their firm to be the attorneys for the estate. So most of my clients want to minimize expenses and maximize the amount for their beneficiaries. So, I highly recommend that you choose someone who is, has that skill set. If it's a family member, it's great because most family members waive the fees, the trustee fees. And if you use a professional trustee, either a professional trust company or tax preparers and CPAs very often have bill paying services already in their practices. So they are a natural, executor or trustee or personal representative.
Yeah. Thank you. I agree entirely. So someone asked, what are the benefits or disparities of a reversible versus an irreversible trust? I'm thinking they mean revocable versus irrevocable. Is that what you all are thinking?
Yeah, that's what I believe they're asking about. I even just looked up reversible and irreversible just to make sure I wasn't missing something. But yeah, that's a great question. Yeah, that's a great question. I get that often. Revocable trust is, or reversible, if we want to use that, is just a trust that you can change. You can amend it. You can revoke it fully at any time, as long as you have capacity to do so, unless you've written in other scenarios in which it can be changed, which is not typical. And an irrevocable trust, of course, is just the opposite. You can't change it to the degree that it is irrevocable, which oftentimes is completely without court authority. Most of my clients, and I'm sure Matt may have a different perspective, but most of my clients are doing revocable trusts. On occasion, for very specific situations, I'll do an irrevocable trust for someone. Maybe if we're in a situation where we're trying to get qualified for Medicaid, that's an option that's available. If we are trying to make some special bequest to a charity for certain reasons, some of those trusts will be irrevocable. But most of the trusts that I do for 99% of my clients are revocable trusts up until the point that they become incapacitated or they pass. And that's, in my opinion, the best way for most people to approach their trust planning, because they want to be able to change it in the event of some change in their life. Whereas with irrevocable, you're locking assets away in many ways, and there's no more opportunity to change it as life changes.
And then when they pass, then it automatically becomes irrevocable according to law.
That's correct. That's correct.
Can you add to that? Matt, I'm gonna ask you a tax question.
Sure.
Mr. CPA, someone wants to know, if you have an annuity or a Roth IRA, who would be the best candidate for inheritance as to an adult over 70, or children under 10? So I assumed this was a tax question. I don't think it was, but.
Well, there's two separate issues here. I'm going to treat them differently because they're treated differently for tax purposes: annuities versus Roth IRAs. with an annuity, you do not want someone under age 59 and a half, because if they're under age 59 and a half, annuities are subject to the early withdrawal penalties the same way as IRAs are. And that's going to surprise a lot of people. So you want to be careful. If they need the money before 59 and a half, it's treated like a retirement plan. So people under age 59 and a half are not good beneficiaries necessarily of IRAs. The other thing is with Roth IRAs, you want to send the Roth IRAs to whoever has the highest tax bracket. Because Roth IRAs, as long as the assets have been in there at least 5 years, will come out tax-free to the beneficiaries. So, hey, and when they come tax-free, as long as the estate is under the estate tax exemption amount, which is now $12,060,000 as of today, going to half that in 2026, it will come estate tax-free also.
Okay. And Terrence, a couple of follow-up questions to the question about gifting to children. Can a married couple gift $30,000 to each child every year?
Yes, yes. The person one and person two in that married couple can both gift up to that $15,000 number to a child. So yes, it definitely can happen.
And does the recipient of that annual gift, the $15,000, have to report that as income and pay tax on that amount?
No, that gift also should be tax-free to the recipient as long as it's under that amount.
Right. I think you said that when at your beginning that so there's two types of taxes on the possibility, the income tax and the estate and gift tax. And there, as long as you're under that annual amount, there's no estate or gift tax, and then there should be no income tax either.
That's correct.
If I may add on that also, and I get this question all the time, how much can I give to my child and not have to have them pay taxes on it? $12,060,000. Okay. I mean, they said, what? It's like, yes, as of today, $12,060,000. Now, if it's over the annual exclusion, which is generally pegged to inflation, and that amount, that it's actually $16,000 every year. That you just have to, if you pay more, if you gift more than the $16,000, then you have to report it. That's all. There's no tax on it, as long as the gift is under $12,060,000. You just have to report it on a gift tax return. So that surprises people. How much can I gift? $12,060,000, no tax.
But if you want to give and not have any reporting, you stick with the annual amount that Terrence talked about. Yeah. What are the pros and cons of converting existing IRA accounts into a backdoor Roth so heirs do not have to pay taxes? Matt, you want to do that one?
Sure. Well, and that's, if I've had a number of clients who have done that. There's Roth conversions. They've basically converted their traditional IRAs, and then so long as the beneficiaries don't get it within the 5 years, then that entire IRA will be tax-free to the beneficiaries. And it might not be a bad idea to think about it right now as the stock market are taking some drops, because that's when you would want to do it, is you convert it when the stock markets are down, so the taxes are lower. But the one thing about those IRA conversions to Roths is you have to have the money to pay the taxes out of funds other than the IRA. So you have to have other sources.
Okay. There was one here that kind of gets into some specifics about charitable remainder trust, so I'll go ahead. It's a questioner is considering including a university as a beneficiary of their IRA, and by prior agreement, the university would use the money to establish charitable remainder trust? Is any of the initial money given to the university, or well, to the trust actually, taxable by the IRS? And so the answer to that is that, well, let me just go on. Is there something like an IRS discount rate that applies to this gift, similar to the case of a charitable gift annuity? So when someone is a charitable remainder trust is a type of separate trust. It's irrevocable, and the person sets it up with a trustee and so on. It could be a university. It could be, as Matt and Terrence talked about before, an individual or a bank or whatever. Then the assets get put into it, and at that point, there's a calculation that's done to see how much of the trust is charitable. So it's not taxed per se. The assets are transferred, usually tax-free. This, I don't want to get into the weeds on it. There might be a little more to it than that. But the bottom line is the present value of the remainder interest, the interest that's going to the charity, is you get a charitable deduction for. So, you know, say somebody is 70 years old and they put $100,000 into a charitable remainder trust. And I'm going to make up these numbers. I'm sure they're not right, but they may get like a 50% charitable deduction out of it. And then the distributions that come out of the trust are taxed to whoever the individual beneficiaries are. So that's all I'm going to say about that. But I think the last question I have, oh, wait a minute, sorry, more. Can you transfer stock into your Roth IRA? I think that's done all the time, isn't it? I mean, it seems to me the brokerages sort of sell that, right, Matt and Terrence?
That's a question I don't know. I don't know, because I've only had clients that have made cash contributions to Roths. So
I know you can invest some, of course. So
you can invest in stocks, bonds, and anything, but transferring and making the contributions, I don't know.
Well, you know what? That would be a very good question to ask, you know, your broker, right? Because they would know right off the bat.
Mhm.
So
That's right.
to the person who asked that question, check with your broker. Sorry, I was losing my train here. So I want to thank both of you for what you've said today, and let you, if you have some final remarks that you'd like to make right now, here's your chance.
I'll start. You know, thank you all so much for having me here. This was fun. This is actually my favorite part of my job, when I get a chance to talk about these topics and shed light on these things. Because sometimes, you know, in my experience with clients who've come in, they're a little nervous about having these discussions for the first time. So I appreciate being able to do this in an unintrusive manner. Having said that, I would encourage everybody out there, if you don't have an estate planning attorney, if you don't currently have a plan in place, or if you're not in a situation where you're reviewing it annually, I would encourage you to get with an estate planning attorney immediately. I think it is that important, and I'm going all around actually the country sounding the alarm. Even in outside of Michigan, I can't even do the plan for people, but I'm sounding the alarm everywhere, because it really is that important. Our probate practice at my office is extremely busy. They're overwhelmed, and we're on a retreat up here in Traverse City right now. And tomorrow we're going to be planning how to help them not be so overwhelmed. And probate happens when people don't have a plan in place and the crisis hits home. Now, another thing that's a crisis is when the plan that you have in place was not drafted by a true estate planning specialist. Attorneys feel that this work within the attorney world, attorneys feel that this work is something they'll just pick up when they retire, or they'll do it on the side or something like that. And I honestly, when I first started, I started doing this because I didn't like doing the other work I was doing, and I thought this would be a lot simpler. And then I got into it and saw that the learning curve was extremely steep. So it is crucial, it is essential to use an attorney who really can help walk you through resolving those two questions that I said are two of the four most important that we all will deal with at some point in our lives. So last thing, last 15 seconds. I would encourage you, if you don't have a plan in place, before May is over, make contact with an attorney and start the process, even if it's just a call to schedule your initial appointment. I do encourage you to do that before May is up. Thank you all for letting me participate.
Thank you. That was a good words of wisdom. Matt?
I would echo Terrence's comments regarding using an estate planning attorney, someone who focuses their practice on estate planning. Because Michigan, unlike some other states, have no specialties or certifications for estate planners. So divorce attorneys, criminal attorneys, and real estate attorneys can and do those all the time, which is fine because it's more business for us who then fix them all the time. So if you are going to be using an estate or are going to be updating your estate plan, which I agree with Terrence that it's on an annual basis, that you do someone who focuses their practice on it and spends probably at least 50% of their practice on estate planning matters. Because that way, you know, and I'm at the same conference that Terrence is at, because we don't see non-estate planning attorneys come to these conferences. So, but they're out there drafting documents. So, so those are some of the things. So again, I thank you and appreciate being invited to speak today. And I look forward to people making sure that their plans are in place.
Well, thank you, Matt. Thank you, Terrence. Thank you both for taking time out, especially time away from the conference, which I know it's an excellent conference. I used to attend every year myself. So thank you all. Sally Baker, I'm going to turn it back over to you.
Thank you, Donna. For participants, if you need more information, please visit our website at plangiving.umich.edu, or you can call the Office of Plan Giving. Our contact information will be forthcoming in an email that you'll receive within the coming days. I want to thank very much our panelists today for sharing their expertise. We're very appreciative. And we're very happy that so many participants were able to join us today for today's workshop. So thank you so much, and go blue.